Investing 101 time, those Fed rates are coming. Let's bring in Ed Gjertsen, the founder and CEO of Engage Wealth Group. Great to see you, Ed. Investors and people socking money away have been enjoying the Fed rate hikes because higher interest rates are giving them a nice return. But what do they do now, Ed?
Well, great to be with you, Angie. I think one of the concerns that we have in terms of investing in the Fed cuts is the reinvestment risk. We've had savers who were basically penalized all during COVID with really low interest rates. And as those rates really rocketed up with the Fed's raising of interest rates, we've had a lot of folks who got into CDs and high yield money markets, which is great for now. But now that we're most likely on the back end of that Fed cycle curve, right, rates are going down. So these individuals run into reinvestment risk. When those CDs that mature in 6 months to 12 months, the rates that they'll get is much lower. Either individual investors need to look at extending duration on those CDs or looking for other like instruments that'll extend it out even farther. The goal being obviously to lock in higher rates for longer.
Should people put more money into the stock market? How's the market looking to you?
Well, from an equity perspective, equity versus fixed income, if individuals are in CDs, they shouldn't be necessarily shifting that CD money over to equities. But as of right now, you've had stocks that have really, really good run, especially if you look back from March of 2020, they've had a great run. And so ultimately, that balanced portfolio, you need to kind of look at what has happened over that time frame. So individuals, if they have certain allocations to stocks and bonds, those allocations might be skewed a little bit because of equities high performance. So an opportunity for potentially individual investors and investors alike to look to rebalance to get them back into sync in terms of their long-term goals.
Any final thoughts on the stock market and the Fed?
So one of the things that investors also need to be aware of is if they wait for the Fed to start moving rates, they have to realize that the markets move rates well ahead of the Fed. The Federal Open Market Committee targets short-term rates. They don't set short-term rates. They basically target short-term rates. So the markets may have already moved when the Fed really starts in their rate cut cycle. So investors need to think a little bit ahead of that, not too much ahead, but a little bit ahead, because ultimately when the Fed does start cutting rates, again, you may have lost those higher, longer rates for quite some time in the future.
That's so true. The market tends to move ahead of the Fed and has already baked in some of those rate cuts. Thank you, Ed.
Welcome, Angie.
Go to businessfirstam.com for where to see our show on TV.